Hello. Well, I have to admit, President Donald Trump hasn't quite signed the Genius Act yet, but it is imminent. I'm Catherine Ross. I am the news editor over at Blockworks, as well as the writer of the Empire newsletter. And I've got Casey Wagner, who is our senior policy reporter, as well as one of the brilliant minds behind the Forward Guidance brand. Casey, while we're waiting for President Trump to sign the Genius Act actually into law, I'm kind of curious if you can lay out what is in this bill and why it's such a big deal.
Yeah, definitely. Apologies for my voice. I sound like I've been partying, but I really just had strep throat and it's a tough week to be sick. I'll say that. So yes, this week in the House, it was crypto week. There were 3 big bills. All of them ended up passing. The Genius Act is the one that everyone is talking about today because that has already passed in the Senate and President Trump is expected to sign that into law any minute now. The Genius Act focuses on stablecoins. It's the first of its kind. There's never been legislation focusing on stablecoins ever before at the federal level. The industry is very excited about it. Most of the industry, I should say. So this bill passed in the House last night in a vote of 307 to 122, I believe. There ended up being 102 Democrats supporting it, which is pretty huge. I believe there were 68 Democrats in the Senate that approved it as well last month when it passed over in the other chamber. And the basic of the bill is it requires stablecoin issuers to keep fully backed liquid reserves. So this is dollars equivalents, short-term treasury securities mostly. This is huge. It's helping to prevent runs that we've seen in the past. It's ensuring that, people that are investing in stablecoins, their money is safe. Entities with 50 billion or more have to go through annual audits, and these are done through third parties. And that's also something new that we've never seen. Some stablecoin issuers have done that on their own, but there's never been a federal regulation requiring them to do so. And really the biggest kind of point in the bill that the industry was excited about, and there's also some controversy about, is the role that this bill gives state regulators. So issuers that exceed $10 billion in issuance must be overseen by federal regulators unless they're granted an exemption, which can happen. And those who issue less than 10 billion are able to be overseen at the state level. There are some caveats here. So, the state regulators are required to maintain similar regulations to federal policy, and these will be reviewed once a year. So those are the main gists of the bill.
You said that there's controversy, and I mean, I've got to admit, everything that I'm seeing online right now is pretty positive. So I'm kind of curious what that controversy looks like.
Yeah, definitely. So the main issue that those who did not vote for the bill had is this Genius Act does not have any language that prevents the president from issuing a stablecoin. So we know that Trump and his family have crypto interest, and there were a couple amendments put forward in both the Senate and the House to try to make this a clear line. There was not, these are not successful amendments. During Monday night's Rules Committee debate around the bill, Representative French Hill, who's the chairman of the House Financial Services Committee, he was actually asked outright why he wouldn't support an amendment that explicitly prohibited the president of the United States from issuing a stablecoin. And French Hill he said that Trump is not the issuer of a stablecoin. He's a part owner of a company that has issued one. He also noted that there will still be ample disclosure requirements and reserve requirements that will help protect consumers. And he also mentioned that the bill passed in the Senate with bipartisan support. So, there might be some Democrats that were concerned about this, but there were enough to not be concerned to pass it.
And what happened earlier this week? There were some headlines like, we thought the crypto week was off to a great start. Then there seemed to be a bit of a hiccup. And now it seems, arguably, it's a great week for crypto.
Yeah, it's been interesting. Anyone that follows policy knows that anything can happen, and things often do not move as quickly as some people might hope, even when you know that the votes are there. In a nutshell, what happened this week is basically when a bill is being presented to the floor for a full floor vote, it needs to pass through the Rules Committee. So the Rules Committee has a hearing. They pass a rule that allows the House to then vote on a rule to then vote on the bill. A lot of steps. The legislative process is complicated for good reason. So basically, this procedural vote was very important. It failed on Tuesday morning. There was some controversy. Some Republican lawmakers were concerned about the nature of the three bills being separate. So these three bills were the Genius Act, the Clarity Act, and the Anti-CBDC Surveillance Act, all three of which did end up passing. But there was a faction of the Republican Party that was trying to combine the Genius Act with the Anti-CBDC Surveillance Act. And without their votes, these procedural votes did not pass until later. It did take a while. There were a lot of closed door debate meetings, I was told. It went late into the night. I think they ended up passing this procedure like after 11 p.m. on Tuesday, on Tuesday. And eventually we got it over the finish line.
Nothing is ever dull in DC, huh?
No, it's not.
My other question for you is, why would they want to marry these two bills together?
Yeah, the faction of the Republican Party that was concerned about this was from the Freedom Caucus. And there is a lot of concern about CBDCs from this faction of the party and from other parts of the party as well. It's in the name of the bill, Anti-CBDC Surveillance Act. This is a bill that prohibits the Federal Reserve from issuing a retail stablecoin. Proponents of the bill argue that it's necessary for maintaining financial privacy, and the holdouts in the Republican Party wanted that set in stone with the Genius Act. It's easier to get things done that way. Of course, if that had happened, they would have had to send it back to the Senate for the Senate to then approve it again, because it would be a new version of the bill. And it would complicate things, which is why it ultimately didn't pass. But there was, a strong enough part of the party that was pushing for that we ended up getting delayed.
And what about the momentum here? Now we still haven't gotten the signing yet. I'm watching the live stream, but assuming that we do get the signing today, imminently, do you think that this builds up enough momentum to get the other two bills across the finish line?
Yeah, I don't know. We know that President Trump said that he wanted to see a stablecoin bill and a market structure bill passed together. We're obviously not seeing that. So the Clarity Act is the other bill that passed in the House. That will now move on to the Senate. This bill, it's a lot longer. It's like 500 pages. I think the Genius Act is around 200 or 300. It's more controversial within the industry. It's definitely more complicated. It breaks down the roles between the CFTC and the CFTC and the SEC, excuse me. And it defines digital commodities, which is really big for the industry. It also includes a lot of definitions around decentralization, which some of the industry is really excited about. Other parts of the industry argue that these definitions are too strict and they feel like their protocols are decentralized sufficiently. However, according to this bill, they would not be classified as such. So it's more complicated. We're going to see a lot of lobbying efforts move forward. Coinbase is a big fan of the bill. Some others aren't. It's going to take longer. We saw that the Genius Act, it did pass in the Senate with pretty strong bipartisan support. However, you know, there weren't, the Clarity Act's a lot longer.
I saw a tweet from Miles Jennings of A16Z, who I'm also assuming is a proponent for this bill, because he said that he liked the maturity framework and that it's the best regulatory approach to decentralization that he's seen proposed. Is that kind of what you're hearing from people who are pro this bill?
Yeah, there are aspects of the bill that a lot of people like. There's some roles for, it allows for self-custody, it protects software developers and other protocol people that work in protocols from adhering to some of the more strict disclosure requirements that they argue they don't even have the data to be able to comply with. So that's really huge. But like I said, it's a more complicated bill. I think the Genius Act was fairly straightforward as, you know, a multi-100-page bill could be. But the Clarity Act is seeking to accomplish something that is just a lot broader.
Okay, so I think we can give your voice a break here, and we can bring on another Casey, because there's so many Caseys here.
Yes.
Hello.
Hey,
Hello.
Casey.
Welcome, Casey.
I don't know if a lot of people have this thing where they're like, they hate speaking their own name. I don't know if anyone else is like that. So I'm something about saying Casey when I'm referring to myself gives me the ick. So this is a very rare thing for me to actually say the name.
Yeah, me too. It's fun. Well, thank you so much for joining us. We really appreciate your time.
Yeah, of course.
Catherine, do you want to kick it off, or should I?
Why don't you?
Okay, great. So Casey, you're a partner at Stewart and Kissel. We're curious to hear your perspective on the Genius Act. Let's start with the non-bank financial institution aspect of this bill. So you specialize with non-bank financial institutions. From your experience, how does this bill impact those issuers?
Well, for the non-banks, it really opens up the playing field. You know, there is a path to issuing stable coins that is very clear, and there is a path for them to become regulated by the OCC, by the federal government, which was not necessarily a clear path before. That largely related to the OCC's power to issue bank charters under the National Bank Act. And then the National Bank Act, I should add, the National Bank Act of 1866. That's how dated we're talking about. So there's a clearer path for that. And one of the big upshots, there are two things that really jump to mind right away. The first is that an OCC trust charter, which is an avenue available to these players now, is not a bank for the purposes of the Bank Holding Company Act. So you can have a non-bank or even a non-financial institution top level company that can engage in stablecoin activities. So it doesn't necessarily have to be limited to a financial institution like a Coinbase, for instance. It could be, you know, entities engaged in commerce can jump into this field now. That was not an avenue that was available, and it is in some ways the culmination of this, destroying of the historical separation between banking and commerce that was first established in the Glass-Steagall Act of 1929. So, or 1933, sorry. So, you know, that's one thing. The second thing it does is that non-bank stablecoin issuers can potentially get access to Federal Reserve master accounts. And that's the way money has to move in this country, regardless of whether it's an ACH, whether it's a debit card transaction, credit card transaction, PayPal, what have you. Ultimately, all roads lead into the Fed and the Fed master account structure. The only way to move money is, unless it's cash, is to move money between one Fed master account to another Fed master account. And this now opens that possibility to non-bank stablecoin issuers. So those, in my mind, are the two big ramifications.
So I kind of have a twofold question for you. I'm going to start with one and then we can go to the next. The first one is, can you define what those non-bank institutions are, just so we understand?
Yeah, I mean, it could be, so it could be basically anything. The defined terms are, federally qualified issuers and state qualified issuers. I think your previous discussion with the other Casey was, or first Casey, I'll be second Casey, kind of touched on the qualification levels for each, and the larger issuers would need to go through a process of getting OCC approval, where smaller issuers with under 10 billion in issuances could be regulated under a state level regulatory regime that doesn't necessarily exist right now. That's one of the things. This structure where you have the option of going through a state regulatory scheme that doesn't necessarily exist is something that has already been tried and tested, which has to do with the mortgage loan origination licensing scheme under the SAFE Act, which has been around since, was that 2000? SAFE Act was 2008. So the response of the state regulators was very quickly to set up a state regulatory scheme. And I would imagine there's going to be a race among state regulators to issue regulations or statutes that respond to the federal impetus.
And what about demand? What kind of demand are you seeing?
Well, there's, I mean, in some ways that's an open question. Stable coins have been a method of settlement in this industry for quite some time. We see that with the duopoly between Tether and USDC as mechanisms for settlement of transactions in other digital assets. This kind of does open up the possibility of retail stablecoin use for payments transactions that does not exist now. There's a huge market for digital native retail transactions. I mean, you could see it with Cash App and Venmo and PayPal. They're ubiquitous. If these payment stablecoin issuers are able to get transaction costs lower or improve the user experience in some ways, I think the demand could be pretty gigantic. And we'll see, the Genius Act would permit merchants to take, payment in a payment stable coin. So in some ways, the sky is really the limit. It's just a question of whether the stablecoin issuers can support transactions that are more economical than the currently existing applications that are out there. If they can, then they can steal market share from Venmo, Cash App. If it's more expensive and more cumbersome and a worse user experience, they won't steal any market share from them. So it does open up the marketplace very broadly.
Yeah, definitely. And I mean, we've seen so much more stablecoin adoption in the last couple of years, but obviously regulatory clarity is expected to really open the floodgates. So I'm excited to see more of those use cases play out. Casey, you mentioned the state regulatory aspect and how states are going to be kind of racing each other to come up with these regimes. I mean, do you think states are ready? I know like certain states, New York, for example, has its BitLicense regime. They're a little bit further ahead of the curve on crypto regulation. Are there certain states that you're watching? How do you feel like state regulators are broadly, I guess, positioned to take on this responsibility?
Well, we're still going to need regulatory guidance from the Treasury Department to guide what the baseline requirements are going to be with the state regulators, what they'll have to, kind of the floor that they'll have to write their laws to meet. But you know, the states that I would expect to be very active in pushing for a state regulatory scheme as quickly as possible. You know, New York has Adrienne Harris is the over the Department of Financial Services, the state regulator. You know, she's put a marker in the ground for years now that she wants to be the most crypto forward state regulator, at least among the large states. So I would expect New York to be a major player in this space, given its position in the financial markets and you know the DFS's stated position. You would also expect to see the same out of states like Wyoming, which has been very forward leaning. I would anticipate among the larger states, Florida might be a little bit more forward leaning. California is kind of up in the air. I know there are some, you know, California is the home of so many tech firms that would want to leap into this space. But number one, most of those players are probably going to be over the 10 billion threshold very quickly. They'll probably want to go the federal route. And California, you know, there may be some consumer protection worries that they're the only state that has their own consumer protection department, like a state level CFPB. So we'll see what California ends up doing. Same as Texas. Texas has a very robust state regulatory scheme for financial institutions, very well respected staff of that office. They have, I would say, not been, you know, leaders in the crypto space necessarily, although they're not going to be that far behind. But they're more cautious than the average onlooker might expect. The other so Louisiana has also, they have the equivalent of a BIT license. I would be interested to see how quickly Louisiana moves. So they're you know, kind of the folks you would expect to lead the push. I would expect that to continue. You know, I'm not expecting, and maybe there's a small state other than Wyoming that tries to jump in just to, you know, steal regulatory market share, if nothing else. But we'll just have to wait and see.
Yeah, definitely. You mentioned consumer protections. I definitely want to go back to that. But first, so the $10 billion threshold does allow, if you have over $10 billion in issuance, this bill allows you to apply for an exemption to be overseen at the state level versus the federal level. Can you explain like why an issuer might want to go that route? I mean, we know that the state regulators are going to have some federal oversight. You know, there's certain requirements that they'll have to meet, but why would an issuer prefer to be overseen at the state versus federal level?
Maybe they perceive that a certain state might have a lighter touch regulatory scheme. And, you know, it's really, you know, at the examination level, certainly the OCC has a very large examination staff. They've been in this game a very long time. They are used to examining and supervising the largest banks in the country. So they know what they're doing and have the resources to do it. You know, whereas some states, especially smaller states, have lower budgets and less staffing, and maybe there could be a perceived regulatory arbitrage opportunity there, where someone as a big player might be at the state, regulated by a state that does not have that type of the type of resources to really hold their feet to the fire. I don't know. Typically, the larger players in any regulated financial market, they tend to want the federal regulation if they can get it, just because it's a lot easier to deal with one regulator than multiple regulators. But again, we still have to wait on you know, what the Treasury Department's guidance is going to be to states to see what this framework really looks like, and then everybody can sit down, look at the regulatory framework as it exists, and make their determination.
I'll
Okay,
jump
I've
in
got
with-
one last question.
It does look like Trump just signed it a few seconds ago. So Genius
Okay.
Act is actually law.
There we go. Look
All
at
right.
that. Both Casey's on this call. Good luck.
Yeah.
Okay, Casey, you mentioned CFPB, so I want to just hit on that in my final question, which is just that there was a lot of debate about whether or not the bill provided enough consumer protections. It doesn't complicitly give oversight to the CFPB, but I'm curious if the agency's power will remain intact through the existing, through the existing jurisdiction.
Yeah. I mean, whether we have a CFPB in a couple months is anybody's guess. If the staff gets shrunk down to about 150 person skeleton crew, they're not going to be doing much of anything, just because they're not going to be able to. The bulk of the layoffs would be in the examination staff. As to whether there are consumer protection implications, right off the bat, Regulation E would apply, unless there's some sort of regulation that would exempt stablecoin issuers from Reg E that we haven't seen yet. So there would be, in the general prohibition on unfair, deceptive, and abusive acts and practices applies across the board, and even state attorneys general are deputized to enforce that. So I don't expect there to be a huge CFPB angle to this market in the near term. If things change, 3 years from now, we'll see. But at the outset, the consumer, there are a number of state regulators and private litigants who can enforce certain consumer protection laws. So that's kind of where issuers need to be cognizant of the risk. It's not necessarily at the CFPB level the way it has been in the last 14 years or so, but the legal risk is still there, and the issuers will have to be cognizant of that.
Well, Casey, I really appreciate you taking the time to join us and talk about this bill, and now it's in law, and we appreciate you celebrating this milestone with us.
All right, anytime. Thanks.
Thank you. All right, we have another guest waiting to join us. Anna, I believe, is backstage. We'd love to get her out here. Anna Yuan, welcome. How are you?
Thank you. Thanks for having me.
Yeah, thanks so much for joining us. It's been a really busy week for you. I'm sure you've been watching everything super closely. Why don't you start by telling us what your company does? I know it's a stablecoin infrastructure provider. I'm really curious to hear your insights into the Genius Act, but in your own words, tell us about you.
Sure. So I'm the founder of Perenna. Perenna currently runs the largest stable swap on Solana. We're building stablecoin products. So I actually started off, and this will tie into Genius Act. I started off wanting to unify fragmented stablecoin liquidity on Solana in the very DeFi native way. Previously, I was at Solana Foundation. I saw the inflow of dozens of stablecoins launching, and I'm like, okay, these stablecoins need liquidity. Now, coming back to how this bill passes, it will impact the singleness of money, because previously on chain, stablecoins are traded slightly off peg. And this is what a lot of critics are saying, why they prefer tokenized bank deposits over stablecoins, because stablecoins are not truly pegged. However, I think, and this is where Perenna is also transitioning, is into the crossroads of permission and traditional, like centralized finance and DeFi. And I think those will coexist. And we'll be able to offer this, mimic the singleness of money with various stablecoin issuers at a one-to-one level, because these issuers are now regulated and we can trust that they're offering, their stablecoins are properly collateralized, and we have a relatively standard risk framework. Therefore, these stablecoins can be one-to-one.
So the Genius Act probably feels like a long time coming for you. I think that, I said this a few minutes ago, we've obviously seen a lot more stablecoin adoption recently, but I think that everyone was kind of waiting for regulatory clarity as a catalyst. for more adoption. So I'd love you to kind of expand on that. I mean, what are you expecting? Where do we go from here? And what does Genius kind of set up the industry to do?
Sure. Earlier I saw Casey's other guests like commentary on some of the regulatory things. So for example, the consumer protection side, and much of that is on the domestic US use case. Now the critics on like FT, Wall Street Journal, etc., they're arguing that stablecoins are actually worse form of money for US consumers. However, they neglect the fact that stablecoins are the tool for the dollar to maintain its dominance and further its dominance globally, and also to further increase use cases that previously were too high friction for dollars to actually settle, and now we can settle. So specifically, what are those use cases? Those are typically cross-border transactions that previously the economy just didn't have that output, and now we can have those economic output via the settlement of stablecoins. Those are further remittances, peer-to-peer, and all of those are the base layer of payments. And what comes with robust payments is you start having lending, because you start having on-chain record of transparent, mutually agreed upon information, and that information leads to credit. So in the US, we're really used to having credit bureaus rating everybody, and there's like businesses have credit ratings by say S&P and Moody's. Internationally, much of that does not exist. So therefore, individuals don't get loans, and businesses don't get loans, or they get blanket loans, and that's super powerful with like having stable coins be adopted. And we're at a precipice where it's actually very smart, albeit it's a trade-off for the US to pass the Genius Act, because with this regulation, it means more and more both domestic and international businesses and individuals would be willing to hold these regulated stablecoins, and therefore further the dominance of dollar, and therefore further the dominance of dollar in financial markets for borrow lend and for all the use cases later. So that's, I think, it's a long process. Like in the next 10 years, 20 years, I'm super excited to be in this career, to see the transformation. But a lot of these we're just seeing like step one in the multi-year journey.
I guess like in
Anna,
terms of, oh, sorry, go ahead, Catherine.
No, go ahead, Casey.
No, I was just going to say, like, in terms of the current stablecoin landscape, what kind of opportunities does Genius open up for growing that? Why do we need more stablecoins? Where do we need them?
Yeah. Arguably, one does not need more stablecoins. Like, it would be great if everybody uses one, but it was smart of like the US to keep it separate, and nobody really wants a CBDC. So why do we need so many stablecoins? Different use cases, different value transfer and value assignment. So generally speaking, in the whole stack of like stablecoin issuance, you have the issuer, the technology provider, the banking partner, the collateral, the like reserve manager, etc. And then there's the distribution partners. Right now, pre-Genius Act passing, major players were either offshore, so that's Tether, under MTL structure, that's Circle, or under the NYDFS like state level license, which is like Paxos being one of the more notable ones. Post Genius Act passing, a lot of that will get properly bucketed into onshore stablecoins for the ones that are above certain threshold, and the ones below, which is the state regulated. Now all these get more, which previously Casey talked about, they're getting more access to the Fed, the ledger at the Fed, to various other things that previously non-bank financial institutions did not have access to. Those will impact the distribution layer, because previously like let's say Tether simply don't have US banking rails. I don't think they were able to, well, they are, but they don't really advertise that they can send money from JP Morgan. You can't send money from Chase to go mint Tether. Now this corridor is going to get slowly open, where there's like compliance costs, etc. But in the beginning, you see only large mint burns. Now we're at the point where, like for our stablecoin, you can mint $1 through our licensed banking partner to get the stablecoin. In the future, it might be like less than $1. You can mint it anytime you want. It's going to be instantly settled, and you're breaking the barrier between on-chain and off-chain dollars. But the on-chain dollars can do a lot more things. So bucket-wise, there's privately issued closed loop stablecoins. Some of them are really just used by fintechs because it's cheaper, like FBO accounts. So if you're a fintech, you hold like 200 clients' money on a bank with your banking partner. That's a whole lot of headache versus you just hold 200 clients' money on a blockchain and you have a list and you can manage them any way you want. That's super easy. That stablecoin maybe never sees the light of day outside of that company's own ledger. That's totally fine and totally cool. Other stablecoins are like branded stablecoins. So kind of like how IP is distributed or intellectual property. Like for Prena, we're a distributor, so we're strong at branding. How we distribute is we work with other collateral and other issuers where maybe we're white labeling them or we're using partially their collateral. And we distribute to our end customers so the end customer would know who we are. There are plenty of other brands or platforms or et cetera that have their own core audience that would do the same. And then lastly, I think the financial institution stablecoins are like a whole beast on their own, and they're looking at the more consortium landscape. If you look at like Citi, JP Morgan, and what was it, Bank of America, the three of them are like kind of trying to figure out what to do so they can keep their market share. I think that's on one hand, like people like us, we're all like, oh, we want to disrupt the banks. On the other hand, it's quite nice to see banks reacting to this because you hope that they will provide better service to the end customer.
And I'm going to have to send that whole response to my father-in-law because he had that exact question for me last weekend. And I think I just kind of dawdled through it. I don't think he totally understood how I was breaking it down, but you did such a good job. So I appreciate that.
Thank you.
You actually mentioned Bank of America, and I kind of wanted to touch on these institutions because this week alone, we've heard Bank of America CEO once again reiterate they want their own stablecoin. We also heard Charles Schwab CEO say that they want their own stablecoin. I'm curious if they've all obviously been waiting for the Genius Act to be signed. I'm curious if this is the next catalyst that you see for stablecoins.
I think it is, but I don't think it's the main wave yet. I remain cautiously optimistic because if we see, I remember like reading through announcements in 2021 or even 2018. I think 2018 was peak when Ripple and all the banks, every single bank announced an LOI on moving payments on chain, and nothing came about from that. So I would say this is the time where these banks in 2022 shut off their entire blockchain team, or most of them did, and then 2025 rebuilding that. So it's going to take a while before some of the pilots come to fruition. Now, this is where I'm particularly excited because between that period in the last 5 years, some of these institutions kept a team and they kept iterating on it. So for some of them, I won't specifically say which ones, but they have been piloting, and I think they're close to integrating some of those services into their main technology stack or tech and service stack. Whereas others are way behind trying to catch up, as in like, for example, Bank of America seemed a little bit more behind because they were previously quite negative towards crypto. Wave-wise, I don't think the average US consumer will hold stablecoins. I don't think more than 10% of the average US consumer will hold stablecoins by the end of next year. So I think we're still very early. However, on average, businesses that run international trade, I think 5 to 10% could be holding or could have touched a stablecoin, even if they didn't know that. But they probably will have touched stablecoins by the end of next year.
I just have to say, it's kind of cruel on a call with two journalists to say I'm not going to name names. But we can move past that. Prior to this week, I was having a lot of conversations with people, and one of the things I kept hearing, because we've been covering stablecoins so much, is that they're starting to get stablecoin fatigue. Like I literally had somebody in a meeting say, please don't ask me another question about stablecoins. And so I'm wondering if the signing of this bill kind of reinvigorates the narrative a bit.
I think it will. I hope it will, because stablecoins is my whole life and I love talking about it. I will never get fatigued. So please ask me. I think it will, in the sense that there's so much more to stablecoins. We kind of anchor it off of stablecoins, but my mental model is composable currency, because different types of assets are storage of value. But when you think about meaning for what is money, right? like storage of value, medium of exchange, unit of account. Previously, an asset only fulfilled one, and a dollar only fulfilled the other. Even like a money market fund was outside of big banks and Fortune 500s, where you can use it as both. You only fulfilled one function. But what composed work currency is unlocking is that, okay, we understand stablecoins now allow money to move at the speed of the internet, which is kind of mind-boggling that humanity accepted the fact that it doesn't for so long after the internet exists. But what's next? So what's next is not only does the dollar or euro or other fiat currencies move like currencies, but other assets can move like currencies too. So one example is trading strategies. Previously didn't even have a name for this asset class. I think they should be called an asset class, and it is a prime example of a prime case study of how it could be turned into a currency that is really stable once you understand the risks. And what's further is that dollars are actually very not composable in traditional finance, to the point where we all hold dollars in various different accounts, and most of it probably just sits there. And most we earn some like Fed fund minus 1% rate. However, what's going forward is all these dollars that people, especially like businesses or sophisticated institutional players, hold can be used in so many more ways on chain. And that's what DeFi calls composability, but in traditional finance, it was just like super siloed. I think many other asset class will come, and one day maybe when people are so stablecoin fatigued, they will start talking about RWA and give RWA a more apt name than what TradFi hates, which is like, it means something else outside of crypto. But stablecoins is like the first RWA that's coming, and there's like a lot more that's coming. So I think in addition to revolutionizing payments, there's like a ton of other financial engineering, and the entire financial infrastructure will become, I hope it will be completely different from when we first started, which is like almost 10 years ago when Bitcoin began. And then 20 years later, it'd be like an entirely different system. So yeah, this is why I'm not tired of talking about stablecoins, and I think it's like super, super interesting.
Hey, I appreciate it, because I can also talk about stablecoins all day, but I won't take up any more of your time. I think we've taken up enough. We really appreciate you joining us today, Anna.
Yeah,
Well, thank you so much for having me.
I hope you're doing something fun this weekend, celebrating
stablecoins.
Yeah. Well, I'm sure it's going to be a really busy next few months. So hope you get some rest in before that. But yeah, thank you so much.
All right, nice
Really
to
great
meet you guys.
Bye. All right, Casey, we've only got a couple more minutes left. We kind of talked about the more like, laying out the bill and all of that at the front, but I kind of want to get your thoughts on it now, if that's okay. And if you've got thoughts, which I'm assuming you do.
On the bill?
Yeah, like on the bills signing, what you've heard, what the next steps could be, any of that.
Yeah, I mean, I do think that, like I said before, I think that stablecoin adoption, a huge barrier was regulatory clarity. I think we have that now, but I think Casey Jennings earlier made a really great point that it is going to take a while. We're still waiting for federal regulators to tell the states what the requirements will be for their regulations. And then after that, we have to wait for the states to develop their regulatory regimes. So it is going to take some time. I do think that there's a lot of excitement in the industry right now. I think that, like I said, this is a huge barrier that's been blown out, which is amazing, but it is going to take a lot of time. And it's something that we'll be watching, something we'll definitely be writing about and covering. For the industry, it was a landmark week. I mean, this is the first federal law that regulates stablecoins. That is huge for the crypto industry. I don't think it's catching on mainstream quite yet. A lot of my friends in finance actually hadn't even really heard of the Genius Act. So I think I'm curious to see how that kind of maybe starts to change in the next few weeks and months, and maybe as the Clarity Act moves over to the Senate and we hear more about regulation and legislation on market structure, stablecoin legislation will also just become more popular. So yeah, I'm excited. It was a really busy week. I'm excited to have a nice weekend and stop watching congressional live streams. But yeah, it's been exciting. It's always fun to cover an event that the whole industry is excited about.
Yeah, no, I agree with that. I think what's kind of funny is that, and I'm not trying to take away from this bill, it's huge. I don't want to understate that, but it does kind of feel like a hurry up and wait situation where we kind of get over our skis as an industry, where we're like, oh my God, this is it. They're mentioning in earnings calls, we're going to see real action on this, but everything kind of moves at a snail's pace and we almost have to slow ourselves down. Because otherwise, like you said, your banking friends aren't there yet. I have talked to people who are also like, I don't know, like it's cool, but what does this actually mean? You know, like we're getting too excited. Maybe we need to calm down just slightly.
Yeah, it's definitely early. But like I said, I mean, anytime the industry is all talking about the same thing, it's always fun just as a reporter. And yeah, I'm really curious to see which states issuers start flocking to, who has the best regime.
Yeah, that's going to be, I think, one of the things that I'll be watching out the most in your reporting, because obviously you very specifically cover this in the Forward Guidance newsletter. So I'm looking forward to that.
Yeah, a lot on the horizon.
All right, we are just about at the 50-minute mark, so we are going to bid adieu and let Casey get to her weekend and rest her voice because I forced her to talk a whole lot.
Might need some tea.
And we officially have this in law. Yeah, and get some tea, please.
Thanks so much, Catherine. This was great, and thank you to our guests and all of those of you who tuned in. Thank you.
Thank you all.